Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning guest on the program today is Jordan Roy-Byrne. He is the publisher of thedailygold.com. Jordan, welcome back to the program.
Hey, Colin. Thank you so much for having me.
Absolutely, and we appreciate all of your updates. You put one out last week just talking about the technicals and fundamentals of the market. Anybody can find that on our YouTube channel, Palisade Radio, or of course at palisaderadio.com. Jordan, I want to talk about the state of the market right now. As a junior resource investor, there's certainly not much money flowing around, despite the fact that if you open up a chart of most commodities, surprisingly even gold, and you look at a chart for the last year, the chart looks pretty good. In fact, some commodities you open up, they're clearly in a bull market. And despite that, most of these stocks just are not reacting well to news. They're not reacting well overall. So let's use that as a starting point. What do you see in terms of just speculative money that's in the space right now or not in the space?
Well, what I see, Colin, is that we're obviously in a new cycle. We're in a new bull cycle for precious metals, and it really hasn't been triggered yet as far as mass speculation and mass optimism. I expect that could be triggered finally when we see this major breakout in gold. Gold is technically, it's setting up really well for a major breakout. Let's conservatively say in the next 6 to 12 months, but maybe it'll be a little bit sooner than that. I think what happens, Colin, is, and we saw a little bit of this in the 2000s bull market, is when metals prices were consolidating and when they weren't breaking out. At times during those periods, you would see the stocks would rally and then the stocks would get oversold, and when the stocks weren't rallying and when they would get oversold, their prices relative to the metals would be very weak. And so I think we're at one of those periods where and this is a kind of an atypical consolidation because it's been going on for so long, an atypical correction and consolidation. But when you think about how long it's lasted and the fact that gold has not broken out yet, then it's not that much of a surprise that the miners are, as a group, are that weak. But as far as speculation, I mean, there are some things here and there. If they have a really good drill result or two, or it looks like they've made a new discovery, the market is just jumping all over that. But those are isolated cases. I mean, not every case is like that. But I think over the last year or so, we have seen a handful of companies where it looks like maybe they made a new discovery and the stock has just shot up and run quite a bit. But really, other than that, it's been a pretty subdued market, and especially for the sector as a whole. And but what that means, Colin, is even though I'm not predicting an imminent breakout in the gold price here in the next couple months, it just, relatively speaking, looking at the value in the junior sector as a whole, what that really means for us is that we should be trying to find the best values, the best deals out there, because even though it may take gold 3 or 6 months before it starts a breakout move, I don't foresee juniors in the sector as a whole really getting that much cheaper. So it's a situation, Colin, where there's very limited downside in terms of price, but there may be some more downside in terms of time, whereas it could take more than a couple months for this market to get in position where it can really begin that breakout move, where you see gold run up to 1375 and then it has a little pullback and then it explodes above 1400. I still think there's a little bit of time to go before the market will be in position to make that move. But as I said, that being said, I mean, this is still a really ripe time for people out there to really do their research, find the best companies that are trading at the best values. Because, Colin, if we're looking, if it's 18 months into the future or 2 years into the future, we're looking back, I mean, you can see metals prices substantially higher and things have already run up 300, 400, 500%. And then there's just not going to be the value out there. So traders and investors just really have to be confident about where the gold price is going over the next couple of years and looking at the value that's out there right now, and not worrying about the fact that, well, maybe this breakout is not imminent. Maybe it's going to take another couple quarters for it to happen.
Jordan, I like how you characterize the limited downside in this current market, which is something that I've been focused on. I think back to 2 or 3 years ago when we were saying we just need the US dollar index to top off, or we just need a broad rally in the commodities, or whatever the case may be. And we now have both of those. It seems like the dollar has certainly made a top. It seems like broadly these commodities have made a bottom. And so now we're just sitting in a waiting game for the stocks to catch up. Is there anything else you're looking at on that broad scale, like maybe the stock market or anything that needs to happen to really set this gold market loose?
Yeah, I mean, the first thing I would say is time. We just need more time. Looking at the gold price, the move in the gold price has really been driven by the weak dollar, and I think the market is also anticipating higher interest rates on the long end, but that's not imminent because right now we see bonds are it looks like they're starting a counter trend move. It's interesting. If you go back to last November, that is a point in time when the gold market began to trend positively with rising long-term rates. That wasn't happening before then, and so that correlation really flipped. And to me, the reason gold is now trending positively with higher long-term rates is with higher long-term rates, there's a couple reasons. If you look at the chart of the 10-year yield and the 30-year yield, like gold, those have also reached multi-year resistance levels. And as I said, they're starting a counter trend move now. So I think it's going to be a little while before yields start to rise again and have a chance to break out. But in the future, when that happens and these long-term bond yields start to break out, that's going to cause issues all over the place. Number one, it's obviously going to cause issues with the government balance sheet. I mean, we're already heading towards $1 trillion deficit, and we're in an economic expansion. We're in peacetime. That's never happened before. You look at the interest on the debt. So with long-term rates breaking out, the interest on the debt, I mean, that could explode much higher. I mean, explode is a little too strong of a word, but I mean, the interest on the debt with much higher long-term rates, that's going to accelerate on the upside. So that's bad. Secondly, it's also going to be negative for the economy and the stock market because just think about, look, the government's borrowed lots of money, but corporations have also borrowed tons and tons of money at much lower rates. They've used that money to buy back stock. They've used that money to fund their businesses, but they haven't used a lot of that money to do capital investment. And they've by borrowing so much money, corporations have levered up their balance sheets. So in other words, what the problem is, when you see higher long-term rates, not only is it bad for the government, but it's also bad for these corporations that, as I said, they've borrowed tons of money and they're going to have to pay that back. Their interest costs are going to be rising at some point. And as I said, it's also negative for the government. So I think, we've seen a little bit of a rise in inflation and long-term rates, but it hasn't been enough of a rise to cause problems for the stock market and the economy. But if you look at the long-term charts of the 10-year, 30-year yields, when these, when those markets break up to the upside, I think that's going to be the point when it starts to cause some of these problems that I was just talking about, and that's when you see it starts to negatively impact the stock market and the economy, and that could lead to obviously some money moving away from stocks and into gold. So with all that being said, Colin, the one key that I'm watching is gold, the gold to the stock market ratio, and that has not done well in recent quarters and years. And so that's something I'm really looking for before we get this major breakout move in gold, is we need to see gold start to outperform the stock market. And I just gave you a fundamental explanation of what could potentially cause that to happen. So I'm not really focused on the weak dollar per se, because look, the dollar has already had a pretty sizable decline and gold didn't break out. So the dollar going much lower after that, that's not going to cause gold to break out. It really has to be something else here. And I think it's going to come from the bond market. And the other issue, Colin, is when we see these higher long-term rates, the Fed, their policy, they're not going to be raising rates aggressively. they're going to raise rates in a tepid manner. They're going to let inflation run. And so, Colin, that's when you start to get real interest rates decreasing and going negative again. And that's obviously very bullish for gold, because if you look back over the last year, Colin, real interest rates have actually increased. So we've had higher inflation, but interest rates have actually increased faster than that. So that's a fundamental reason why gold has not broken out yet. It should not be breaking out yet. But again, looking out over the next 6 to 12 months, that could be a point in time when gold starts to sniff out, higher inflation, the Fed not raising rates as aggressively as they have been, and then long-term rates starting to break out to the upside. So those factors, I think, is what gold is really waiting for. And looking at those factors and the fundamentals of gold, I don't see an imminent breakout. I see something that we just have to be a little bit more patient. It's going to take at least another quarter or two for this move to really set up, and for the market, for the fundamentals to really set up for gold. Because I was talking about long-term bonds. We are going to see a counter trend rally there over the months ahead, where we could see long-term rates come down a little bit, and so that's counter trend to what's been happening. And by the way, I don't pay attention to the Fed. I don't care what they said, but if that's right, and over the next 2, 3, 4 months we do see long-term rates start to come down, then you could see the Fed, instead of doing 4 hikes this year, there's probably going to be talk about them doing 3, maybe even 2. So that's something to look for in the months ahead. I mean, I know that's a long answer and a lot to take in, but both fundamentally and technically, we're just not there yet for a gold breakout. But people have to be patient, because I do think it's going to happen later in the year.
Jordan, your discussion of the debt situation just got me thinking. People always talk about the inverse relationship between the gold miners and the rest of the economy, but a very direct way to look at it is, at the same time as these companies listed on the Dow are taking out record debt, using it for share buybacks and growth in business, and are at the mercy of the bond market, on the other side, many of the gold miners don't have access to that debt. And in fact, if you listen to somebody like Rick Rule, he'll say that these gold mining companies, thanks to the bear market, are a lot healthier than they've been for years in terms of their balance sheet and their cost of production and just the optimization they've been forced to do. So that's another way to look at why the capital would rotate into the sector. These are just better run companies so long as the gold price moves up.
Yeah, absolutely. I mean, that's and that's the gold mining sector. I mean, we talked about it in years past, Colin, the last few years. I mean, the gold mining sector endured the worst bear market basically in 90 years. And if you look at valuations at the 2016 low, if you look at gold stocks relative to the price of gold, relative to the stock market, I mean, they were at basically 90-year lows. So I mean, that's real capitalism, where you have to survive during the bad times. You survive and die, and then when times are good again, you can start thriving. But we haven't had real capitalism for much of the economy, because the Federal Reserve and their quantitative easing policy has allowed these companies to basically, I'm not saying the entire recovery was artificial, Colin, because if you have a bad recession as we had, then of course, naturally, you're going to get some recovery. You're going to get some expansion to follow that. But the problem has been that Fed policy incentivized all these companies to borrow record amounts of money at record low rates. And again, I mean, the stock market hasn't rolled over yet, because long-term rates have just not increased enough to really start negatively impacting these companies. But I really think that and again, pull up the charts of the 10-year yield and the 30-year yield, and you can see right now they're pulling back from important multi-year resistance. But I really think when they break above those resistance levels, that's going to be when we start to see more aggressive increases in long-term rates, and when those higher long-term rates start causing problems for all these companies that their stocks have performed fantastic in the last 5, 7, 8 years, but they're going to be facing higher long-term rates. That's going to start affecting some of these companies, and it's just not natural the way they've been able to borrow record amounts of money and buy back their stock, decrease their share count. I mean, it hasn't been real capitalism, and we're going to see the flip side of that in the next downturn. And as far as rising rates, I mean, just go back. I did an article on this, I don't know, 3, 4 weeks ago, maybe a month or two ago, where looking at, look at what interest rates did in the mid to late 60s and the 70s. And, what would happen, Colin, is you'd have interest rates, and this started in the 50s, Colin, but interest rates they hadn't risen fast enough. They hadn't reached high enough levels to cause the economy problems. But by the time you got to the mid to late 60s is when interest rates and inflation had kind of broken out a little bit. And then you would see a rise in interest rates. They would reach a certain level. The stock market would have a serious correction. Then rates would come back a little bit. The stock market would recover, but inflation would surge again. Rates would go up again. They'd cause more problems. So I think we could be looking at that kind of a cycle, 2019, 2020, 2021, in those years where interest rates have broken out, inflation's broken out, and the stock market is really going to run into trouble. And obviously that's going to be very bullish for precious metals, and especially the gold stocks, because they have not performed. I mean, aside from that huge surge we had in the first half of 2016, I mean, they have not performed well in the last 6, 7, 8 years. And so, I mean, and again, this comes back to the importance of the gold to stock market ratio. Keep an eye on that. I mean, all the listeners, you don't have to be a professional analyst or professional market technician to watch that. Watch gold against the S&P 500 or gold against the NYSE or gold against global equities. Watch those ratios, because when we see that ratio start to rise in favor of gold, that is going to be, when we see all these things starting to turn in the favor of precious metals, and that is probably going to tell us that a breakout move in gold is imminent.
All right, Jordan, well, we've got time for one last question here. I know you follow closely the historical analogs and you try to track the possible changes that might be coming within a bull or bear market. We've been in somewhat of a sideways pattern or a pullback since August of 2016. That puts us at somewhere around 20 months at this point. And that seems like quite a long time. It's certainly been testing the confidence of many gold bulls. Do you have any analogs that you've been drawing on to say, this has to come to an end soon, or can in fact a pullback like this last for however long that it wants to last?
Well, Colin, I don't know I can't recall if we discussed this on the last interview I did with you, but it's something I've written about, a couple times in the last several months. But the best comparison for where gold stocks are right now is really, it's something I call your typical recovery from what is a mega bear market. And I kind of define mega bear markets as something that's lasted, close to 3 years. It has to last at least more than 2.5 years, and it's gone down by 80%. Because as far as price, I mean, there are many markets that have had 80% crashes, but they've only declined for maybe 1.5 or 2 years. So I went back and I looked, and there's 3, 4, or 5 examples of markets that had, we'll call it a plus 3 year type of decline, and then over an 80% decline in terms of price. And gold stocks obviously fit the bill. The 2011 to 2015 bear fits that bill. But some other examples of that are the S&P 500 during the Great Depression, housing stocks from 2005 to 2009, and then Thailand in the mid to late 1990s. And Colin, what happened to those 3 other markets is they had an initial sharp rebound, and then their second phase after that sharp rebound, they corrected and consolidated for at least 18 months. And in some of those cases, I don't have the data in front of me, but in some of those cases, that correction and consolidation lasted as much as 2 years. And there's some other examples that don't quite fit the 3 year, the plus 2.5 years and plus 80% declines. But even those examples have kind of followed this similar pattern where you get a sharp rebound and then the market corrects and consolidates for a couple years. And then after that, it has a massive up leg again. So gold stocks are following that pattern. And, there's can this consolidation continue and last? Well, given what I've described fundamentally, and given, what I I mean, what I've described fundamentally and technically for gold, where I still think it's going to be, at least another quarter or two before we see gold break out or at least start a breakout move. That tells me that the consolidation for gold stocks could continue, but there really isn't that much more downside in terms of price. That's not something I want to bet on. But, going back to the history, I think the shortest correction and consolidation period for these examples was about 18 or 19 months. The longest example, I think Thailand was a little more than 2 years. So I've basically, when I was talking about this stuff 3 or 4 months ago to my subscribers, I was looking at, okay, what could be a time frame when we start to see, the precious metals start to make this breakout move? The time frame for that I've been thinking about was really anywhere from the beginning of summer until the end of this year. So that's really the time window that I've been looking at. And I would just zero in and talk about September, because if you go back over the last 20 years, a lot of the best breakout moves in gold really began in September. So, obviously we can't predict the future. I don't know if the breakout move is going to start in a couple months or 6 or 7 months, but I've generally been looking for something to start, at the end of summer. So I'm kind of looking for potentially September or the end of August. That could be a time when we start to see the market, finally start to move higher aggressively, and then break out after that. I don't see it happening, any time in the next couple months. But again, that being said, I don't see much downside in terms of price. So, listeners, they really should just focus. It's what we were saying at the beginning, Colin. Just understand where this market is. It's not ready to break out yet, but it is in position to have a really good breakout move, in the next 6 to 9 or 6 to 12 months or so. And that's why you have to get positioned now. Use the volatility to your advantage. Don't trade in and out of things. Just find the best companies. Just accumulate them over the next couple months, because, Colin, I think in the next 2-3 years, you're going to be really happy you did that. Look to accumulate things now and in the next couple months. Don't be the investor that just waits for this big breakout move, because if you wait for it, then you're going to be basically chasing juniors higher. You're going to have to buy these juniors 50 or 70% higher if you wait. Take advantage of the values that are out there right now. And again, I think in the next 2 to 3 years, you're going to be really happy you did so.
Excellent. Well, Jordan, thank you so much for coming back on Palisade Radio and talking to our audience here. Once again, Jordan is the publisher and editor of thedailygold.com. Jordan, we'll have you back on soon, of course.
Thank you, Colin.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?